In this video, we're going to be talking about 4 different markets today over here in the futures market. We're going to be talking about corn, which had a limit up today, and we're going to be talking about the Euro FX, gold, and the S&P 500. We're going to do a little bit of technical analysis on these markets so you can see where they're at in their count and in the measure process and see where some opportunities are. I wanted to bring to your attention corn because limit up, that's a pretty big deal. What happened is Brazil underestimated their or I guess overestimated their corn crop by 1 million bushels. So when they made a correction in how much corn they were going to have, they were off by 1 million bushels, and it caused corn to rally and go limit up. Now, what does limit up mean? It means, of course, that it was so volatile, it went up so far that it reached the government's limitation of how far a market's allowed to move before they shut down trading. Now, in the stock market, they'll have basically limit moves in the stock market, but sometimes they only last for 10 minutes or 15 minutes. And then they start trading once again. They can stop it for an entire day, but it's a little bit more rare. Over here, we don't do that 10, 15-minute stop. What happens in the futures market is if we hit limit up or limit down day, we stop for the rest of the trading period. So corn is in a limit up, and it stopped trading today. And you can see that this is the May corn that was in limit up, and it went straight up. And then when it hit $6.50, it stopped trading. Now, we're going to come in here and look at the daily chart. And I'm not going to look at the May corn contract. We're going to come out and look at Christmas corn out here, the December contract, and we're going to do a little bit of technical analysis on this thing just for fun. And I want to show you, this is our grand reset right here, right? So the market started to reset down here where the bars went red, and we got our little flip-flop on the bulls and bears, and then it started to rally once again. So this is where we start over with a brand new, fresh count. So that right there, that little crossover, and I'm going to draw that trend line in there, that crossover across there, that is a new A1. I know you were going to say it before I did, right? A1. So that's a new A1 right there. The market started to rally and up it went. This is our first exit point right here, right? And so we put in our take profit opportunity in there. Now remember, this is X1. So remember, the whole idea of getting into an Elliott Wave strategy like this is that we want to get in at A1 and we don't want to take all of our positions off at X1. So if we get in with multiple contracts, or if you're in the stock market, if you get in with multiple shares, you don't want to take everything out right here. You want to have a stop move to break even. And the whole idea of this is that eventually you want to take off your final exit at X3, all right, at X3. So if this is X3, our overall long-term goal is to take our final positions off at X3. But we can add on here, we can get out here, we can trade all along this trend as we anticipate or speculate, right, speculate that the market's going to make it to an X3. And so this is where we'd take our profits, and then let's take our final profits. But this comes in here, and you can see I'll just draw another trend line right across this peak here, this little pivot point, and then it broke once again with the blue lights right here, and you're going to label that one. Now, I actually had some people say, I don't understand what an A1 is or what a B1 is and why you draw those trend lines in there. Those are entry points. That's where we're going to be getting into the market, okay? That's a trigger point for entry. That's what I call a decision point. That's a decision point. And what you're going to do is you're going to look at your risk versus reward ratio, and basically the way my old mentor used to tell me, this is how much is it going to cost you to find out if you're right. All right, so if you're going to put your money into the market, find out your risk versus reward, where would you get out if you're wrong, calculate that amount of money, and then ask yourself, hey, this is how much it's going to cost me to find out if I'm right. So how much is it going to cost me to find out if I'm right that the market's going to rise? If the amount of money that you have to pay to find out if you're right that the market's going to continue to rise is too much, well then don't take the position, don't take the trade. So that's where we're going to get into the order market, okay? And we can just put an order to get in there, a stop order for entry on the break above those blue lights when the market starts to break above the blue lights and hopefully rally once again, right? If it doesn't, if it goes down and hits our stop order, well, that's our loss, and that's what we had to pay to figure out or to learn whether we were going to be right or not. So the idea is to always put the probabilities in our favor. So the best places to put these probabilities in our favor are these A points, B points. Now, as the market moves up, there's additional locations in which you can add on to your position. And that's what we call these little pivot points. And what we do is we're looking for a higher high, right, and a lower high. And once we find one of those locations, if you notice this example, we didn't get a lower high all the way up, clear up until about right here. And so when it broke above that high once again and started to rally once again, well, again, you're going to have to do your risk versus reward ratio. How much are you going to have to enter? How much are you going to have to pay to find out if you're right, if the market's going to move higher above that position? So I'll calculate your risk versus reward. And this, in this case, is going to be a B2 because that's our second opportunity in the B wave. So what's the B wave? Well, it's the distance between where we get in, where these blue lights are, and where we'd get out. So where we'd get out, well, this is right here. This is our little spike point right here. So this is our exit point. This is X2. X2 off of the second drive, or the B drive, right? So then we get this next drive down right in here, and we, again, draw our trend line in there. Now there's some dip trade opportunities down here if you want to get a little bit more aggressive, and buying on a break above the first yellow bar. That's a dip trade, so you can get in a little early, try to take a little bit of a position down in here. It's a little bit more risky, and sometimes we'll run a flea flicker in here where we do a little bit of dollar cost averaging, right? Maybe build an upside down pyramid in here. So, or not an upside down pyramid, but build kind of a little pyramid shape in here, starting off with a small amount of shares, and as we go down, we add a little bit more, add a little bit more. You can see my cheat sheet for that at stockmarketcheatsheets.com, and where we talk a little bit about building pyramids against the prevailing trend. But that's an entry point, and then we, of course, come in here with, what do we come in here with? This is where we come in here with a C1, right? C1. Why is it C1? Because this is the third drive of the Elliott Wave pattern. So we got drive 1 from the reset. We got drive 2, we call the B drive, and then we got drive 3, which is the C drive. And again, remember, each one of these places is a location in which you can enter into the market and take additional positions. So here is, again, this would be a C2 breaking across here. So there's a C2. Now, it doesn't mean you can't come in here and see these bars down here. Once you get the first bar to make a new high, that would be a trigger. You could also get in down here. Again, that's called a dip trade. A little bit more aggressive, it's a little bit more dangerous, but it's going to reduce your risk, right? Reduce your risk versus reward ratio, which is going to say, well, how much am I going to have to pay to find out if I'm right or wrong? Well, you're going to have to pay a little bit less money, but you might get hit 2 or 3 times trying to take one of these. So it depends on how you want to work your strategy in there. But that would be just a dip trade. So now as the market comes up, we see one more in here. We get this little move right in here. Now, oftentimes we won't even take a C3, and if we do, it's just going to be for a quick scalp because, even a B3 or an A3, oftentimes because the probabilities of those things paying off are a lot lower, right? It's all a game of probabilities, and so this is C3 in here. And that market needs to break above that previous pivot point and rally up. And then, of course, we have our X3, our final exit right there as that market crosses over that third exit. And then as the market comes down, we don't really anticipate another rally. We expect it to make an ABC pattern of some sort and come down like this. We'd expect it to come down A, B, C, and another D point coming down in here, right? And so that would be a calculation off of the low to the high, and we do a Fibonacci retracement back into the Fibonacci sweet spot. That's what we anticipate. Okay, so we're not real excited to take a D drive. Now in here, in this case, this wasn't actually a full D drive. Now you could make an argument that that's a D drive, right? Oh, it just continued on with the uptrend. This is the C drive, and come in here and call that a D drive, and then take it as D1. The problem with that is that we had a full reset, didn't we? The market went clear down into the reds, and we had a little flip-flop here, and so the market failed to the downside, and we ended up here with a new reset. So this is a new reset, and the market took off like a shot one more time, and we had a crossover in here, and so this is going to be a new A1, believe it or not. So because of that little flip-flop and that market switched like that, we went completely red on the bulls and bears bars, and we have a little flip-flop. Usually we'll go for a full 3-drive pattern between the arrows. From arrow to arrow is oftentimes where we'll get that 3-drive pattern. Each one of these little pullbacks in here will oftentimes see yellow bars and not red bars, okay? So right here, we didn't get any yellow bars. The market had too much strength, too much power. Didn't ever come back far enough to give us the yellow bars. But see, in this case right here, it did. It came back, gave us yellow bars, give us the dip trade opportunity. There's no dip trade opportunity in here. There's no yellow bars. Yellow bars give us a dip trade opportunity, and then we anticipate a continuation of the uptrend. The blue light stayed consistent all across there and didn't break, so this was not a dip trade in here, or was not a break of a drive, right? Because it's the blue lights that tell us to drive. This is the Elliott wave right here, the blue lights. And then the mathematics of the Fibonacci ruler are built into the color coding, and that's why the market goes red, yellow, and green. And then the market takes off once again. And so now you can see we've got another little pivot point in here. Oh, let's come in here and finish our setup here. So this is a new A1 in here. And this market came in, and it's going straight up. I mean, this is unbelievable. So just crazy, crazy stuff here in the corn market. And so Again, it has to do with the fact that Brazil doesn't have as much corn as they thought they did, and China is buying their corn as agreed to in the previous administration's agreements with China to buy more American crops, and so we're seeing that happen too. So let's go ahead and draw our channel in here, and you can see that we have the break of the natural trend line, and then of course let's do that with our spider web tool here. So we're going to come in here, and this is the natural trend line broke here. We got the blue lights there, and then the horizontal break right there across the previous high comes in at about right there, and so you can see the 3-drive pattern in there in the little pullback. That's our A1 crossing the blue lights, and then the horizontal pattern right there, and then the next 3 drives up in there. You can see we could label those A1, A2, A3, A4, and now we're way up here in the overbought region. That's where we got, that's where we got our limit move on the May contract. So it'll be interesting to see. I've seen everything happen in this. I've seen these markets when they get a limit move go a full limit the next day, and then a full limit the next day, and continue higher like that. I've also seen them hit the limit days and then flush like a toilet, and then these things come crashing down against that entire big trend. So we don't know what's going to happen. It's going to be interesting to see when corn opens tomorrow, and we're going to be watching this very closely. But that's where we're at in the trend for corn. A lot of corn traders in this market. Plus, we got a lot of farmers that raise corn, and corn's so high right now. The prices are so high. They're so happy. I've seen people digging up their lawns and planting corn in it. Some of these farmers, they're using and maximizing every piece of ground that they have, and so they tearing up their grass and putting corn in there. I've seen that happen in years past as well. So here we are coming in to a nice corn market for the farmers, and as this market continues to rally, we're going to be watching that one very closely. Let's come down here and look at the euro. So this is the euro FX, and euro FX has come down in this beautiful little pullback in here, little 3-drive pattern you can see in here. If we start at the top, this is A, B, C, and you notice it came right down to the Fibonacci sweet spot down in here. This is the Fibonacci golden ratio projection level. Now the golden ratio, we oftentimes talk about a 61.8% retracement as a golden ratio, but in the projections that's 130.9. So this market came down to a perfect 130.9 projection, just like a train on rails. And notice in between here, this is very classic. What we get is we get this little ABC pattern in between these markets, right? So we get an ABC pattern. We get another one right in here. Watch this little ABC pattern inside here. This is real classic. And then of course another, let me tie that one off, and then we get another little ABC pattern in here, just like that. That's really super common, and so that's what we look for when we're trading, right? We look for those little ABC patterns, but oftentimes we get that full little Elliott wave or micro Elliott wave. Sometimes when you look down on a smaller time frame, we as traders get kind of consumed in our micro or macro Elliott waves, and we're down on these little teeny time frames trying to trade these little tiny Elliott waves. Nothing wrong with that, but you can identify these little tiny micro or what we call fractal Elliott waves inside of here. And this is where you get these little tiny moves that we're anticipating on a smaller time frame. And you can definitely trade these. There's a lot of money in there for small speculators. But we got to realize that overall we're looking for these longer moves in the market are generally what we're looking for, and the way we need to kind of keep in mind that the market's making these bigger moves, and then we get kind of myopic and looking for these little teeny micro or macro Elliott waves inside. And even when we get down to a smaller term time frame, we start looking, or even if we get down into a 1-minute chart, if you're a scalper, or a trader in that regard, you might come down and start looking at these little tiny micro or macro Elliott wave patterns. And like we see down here, maybe on a 1-minute chart, then this is what you start looking for, and you start getting, again, a little bit myopic in here, and you stop looking at the longer term charts to see what the longer term trends are. And you can definitely see the different patterns in here. Even down here on a 1-minute chart, we can see the 3-drive micro, I'm going to call this a micro or macro Elliott wave, these little tiny Elliott wave patterns in here. And you can definitely see them in here. I mean, they definitely happen on these small little 1-minute time frames. So there's our drive 1, right? So that would be drive 1. This would be our A1 down in here. So if we were to label this, this would be A1. We would then have B1 here, and we would have C1 here, and this would be our X3 right there. This would be our X2 right there, and this would be our X1 right there. So even on a 1-minute chart, you can see these little tiny micro or macro Elliott wave patterns occurring inside of what we call the overall longer term trend, which you have to also take into consideration. Don't forget that this is also what we're looking for here. This would be, 1, 2, and then looking for that 3. So that's actually an overall long-term Elliott wave pattern, or an X, 1, 2, 3, and anticipate a pullback and a rise once again for the overall longer-term wave of the market. Don't get caught up always thinking in the macro size. We've got to think of the larger term time frames as well. And I oftentimes say that. You'll see that in my documentation where I say I'm a top-down trader, where I'll look at the longer term time frame first, and then we start dropping down to smaller term time frames to see if we can't see entry points on the smaller term time frame for the longer term trends. All right. So now, as we looked at the gold market, let's come in and look at gold. Gold has been in the news, and everybody's all excited about gold. And you can see we've had the little ABC retracement down here. If we come in with our tool, let's just use this one here. So we've come in here, and we've got the nice little ABC pattern. You see that in there? So let's come in and do a Fibonacci projection on that thing and see how it came in. So we're going to go from this peak. And we have to go to where this blue light breaks. You might want to stop right here, but it's actually this one right here because that's where the blue light's at, right? So the blue light break. And then you come right down, you can see it went right to 100%, like a train on rails. I mean, can you imagine that? Look at that. And of course, there's the little waves inside. There's the littler patterns inside that we just talked about. So you can see the little X, 1, 2, 3, 4, 5 waves down in there with the ABC retracement pattern, okay? So as you start to learn these different patterns and what we're looking for on the pullbacks, retracements, projections, and pullbacks, then you can start to make these projections or these Fibonacci projections and trend analysis, and you can be more comfortable in your trading. So you say, well, I'm in the second wave. I'm going to anticipate a third wave. And again, it comes back to that risk versus reward ratio where you're going to ask yourself how much it's going to cost me to find out if I'm right. Okay, so we're going to come in here. I'll delete those drawings. And that's where we're at here in gold. And if you see, this is kind of a reset down in here because we have kind of a double bottom. So you notice this double bottom came in here, bottomed out with the retracement. We ended up making higher highs. And so now this becomes a new, you name it, you label it. What is it? A1, right? And so if that's an A1, that means a break across this pivot point right here. This would be an A2. And remember, the reason we labeled them is because we want to know our probabilities. And our probabilities are the higher we get up in the alphanumerical numbers, the lower the probability that the market's going to continue to higher, and the lower the probability of a successful trade. So if we come in here and label that one, that's just a kind of a little micro pullback right in there. That's an A3, right? A3. But overall, don't forget, these are the little tiny micro, fractal Elliott waves that we talk about. So X, 1, 2, 3, 4. Maybe we're looking for a 5 up in here, and then we get a little ABC pattern in there. This would be another great opportunity to look for getting into this market, right, for a long position. But remember, this is an overall longer term trend too. So this is an Elliott wave. We're looking to go from here up to here, down to here, up to here, etc., etc. Okay, so remember the longer term trend, and these are the little macro Elliott waves inside of the overall longer term trend or the longer term wave. All right, so that's gold, and that's where we're at in gold. And I'm not currently in gold, but I am in silver. I picked up the silver contract on this one, which is almost exactly the same trends, same pattern. So I'm in silver, I'm not in gold. Looking for an opportunity for a pullback, an opportunity to get into gold though. So let's come in here and let's take a look at the S&P. I'm going to pull up the S&P, just the daily chart. We had a big down day today. It doesn't look so bad on the daily chart, but it does, on the 15-minute chart, you can see that thing dropped like a rock. And of course, on the 1-minute chart, we're going to go back and take a little bit closer look at that, how we could have day traded that one. But in here, you can see we got our counts and our measures. This market's just been going straight up, 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 up. We got a couple little red bars in here for resets, right? So if we're going to have a full reset in here with these red bars, that means we're going to start our count over here with A1. So that's A1 in there. Again, high probability of a good trade. The market started to rally in there. It did come back and pop us a little bit in here as it came back, and that hit our X1. And our X1 was actually about equal to our entry, so about a scratch trade. It really didn't pull anything out right there. So that came in with an X1 on that particular rally. But nonetheless, that was a setup here for the B1, which you can see come right across that peak, the high point here, and we got the blue lights. And that's kind of the giveaway, those blue lights. Those are kind of what I call the cheat codes, magic blue smoke of trading. So they're going to come in here, and that's a B1 right there. And so as the B1, we take our long position there. How much do we have to risk to find out if we're going to be right? Wasn't very much. 1 bar back would have been just a very small risk in here, and that's why we like to have very small risks just to find out how much it's going to cost us to see if we're right and make sure it stays inside that bar. If we're wrong, we just get out. Or if you really, feel like, hey, we're starting a new A1, I really do think it's going to go up, you can do a little bit of, again, a little pyramid building in there with the flea flicker and start looking for an opportunity for a little bit deeper dip before it starts to rally once again. So then we come up here and we got another little kind of a little hesitation in here where we got some lower highs in there. And then we got another, not really until all the way up in here. So we're at A2, A3. So this is way up in here, actually B2, B3. So this one here is B2, and this one here would be B3, right? And this one right in here, if we label that one, we're going to be in here at an X2. X2, all right? So that's X2. So is there some upside potential on this market? Yes, there certainly is. What's the probabilities? Well, it's pretty low. So this is going to be a B3 up in here, and that would make this one B2. So B2, B3, if it goes up and breaks across that top, it's probably not going to go very much higher. It might go up a little bit, get a little quick scalp out of it before it falls and comes down and breaks our X2. Gives us a little bit of a retracement, a little breather in here, and then turn and start to rally once more to make that X3 or make that C drive or the C wave up there. Now, I know there's a lot of people who are saying that this market's not going to go up there and make that C drive. Who knows? Nobody knows, right? What we're going to do is we're going to have to, wait until we see the pattern, wait for the setup, and then decide if we want to spend a little bit of money to see and find out if we're right. How much our risk versus reward ratio is, decide how much it's going to cost us to find out if we're right. I want to drop over here to the 1-minute chart first and show you this drop in the market this afternoon. Let's squeeze that down a little bit so we can see it a little bit better. But we saw this market, I'm going to come back before that big drop so you can see kind of the scaling of what we were looking at prior. And this market was just real choppy through here. This was nothing really happening, real ugly market right through here. It did start to pick up right around 10:15 a.m. my time. That's 12:15 in New York. And you can see that this is the overlap of the London session and the New York session. London should close down. Once that happened, New York was all by itself, and it started to smooth out a little bit. So, having those two markets overlap each other gave us a little bit of chop in there. But once we hit that 10 o'clock mark, my time, 12 o'clock noon, the market started to smooth out a little bit, and we actually ended up getting a little trend in there. So we had kind of a nice little crossover, a little start right in there, changing from red to yellow and going into that new trend right in there. Hindsight, you can look at that and say, well, that's a new A1. We probably really wouldn't have picked that up and started trading it because, we have been in so much chop and we've probably gone away and done something else. But had we been watching that and I brought this to our attention, and it didn't mind, I wasn't in this market, I didn't day trade this in the afternoon session. And so you can see in here a nice little break right there across the blue lights. And that was a beautiful little downtrend, whether you would have been smart enough to take that one or not, because this would have been a B2 looking for another rise in the market, right? So this, if we label it, that would have been X1 and this would have been X2. So we wouldn't really have been looking to go short on this X2 right here. This is just an anticipation of a continuation of the long trend. But if you miss that, because that's the big giveaway, this market started to crash, and then you're like, oh my goodness, look at this big drop. This becomes a new X1 A1 long, right? So X1S, actually, because it's to the short side, A1 to the long side. So this is an X1S or X1A1. And then we get the next drop right in here as we're looking for a short position. As this market comes in, we're going to draw just a nice trend line right up through there. And then, of course, that beautiful setup for us to the next short position. So if you were paying close attention and watching the markets and you see this big drop, this is your second shoot a drop or your second opportunity as we come in here. And this would have been a nice setup for a B1S. My favorite setup, right? I like the B1S. That's my favorite. So that's what we call, if you've watched my other videos, if you've gone in and seen my course called the Heisenberg strategy, the Heisenberg setups are always B1Ss. That's what they are, okay? If you have a B1S, that's a Heisenberg setup. And we always look for that first drop, the second shooter drop on a downtrend. If we can catch that thing and have a small risk versus reward ratio, again, how much money is it going to cost you to find out if you're right, is the game you're playing here. And if I take my dollar calculator and just draw that in there from blue light to blue light, that was a $1,237 move. You're like, well, how much money did I have to have in my account to trade that? If we come over here to our key, you can see that to put that on in a day trade was $500. So you have to have $500 in your account. Basically, it's not we don't call it a $500 investment, but basically you can think about it kind of like that. I have to have $500 to put on one contract or one position in the futures market in the S&P, take a short position. So it's a $500 investment. And if we went from blue dot to blue dot, that was $1,237.50. Now, of course, that number doesn't represent commissions and fees. And that's just a quick rundown of corn, euro, FX, gold, and the S&P 500 today.